You know the feeling, right? You draw what looks like the absolute perfect trend line, only to watch the market just completely smash right through it, stop you out, and then, almost instantly, reverse right back in your original direction. Man, it is literally one of the most frustrating experiences in trading. And honestly, it's a massive reason why statistics show up to 80% of retail traders are losing money. You're just sitting there staring at the screen, wondering, wait, are my trend lines actually keeping me aligned with the market's real momentum, or are they just trapping me in these random, low-probability setups? Well, the harsh reality is that most retail traders are using trend lines to blindly guess where the market is going, and they're falling right into fake breakouts and liquidity sweeps. But don't worry, because today, we are going to fix that completely.
Okay, let's dive into this. Welcome to The Explainer. Today, we're taking a highly structured, totally no-nonsense look at exactly how to draw a trend line in Forex, and we're going to put a special focus on volatile pairs like XAU/USD. We're going to strip away the guesswork, ditch the emotional bias, and avoid those classic retail traps. I'm going to show you how to use this tool not just as some random line on a chart, but as a precise framework for understanding how institutions actually move the market.
Here is our quick roadmap for today. We'll start with the power of trend lines, move into mastering the uptrend line, then master the downtrend line. After that, we'll get into the advanced stuff with SMC and market structure, and finally, we'll break down correct versus wrong trend lines.
All right, kicking things off with Section 1, the power of trend lines, identifying the market's pulse.
So before we even think about clicking that drawing tool on our charts, we really have to understand its fundamental purpose. You see, you can't just draw lines and cross your fingers hoping price reacts to them. You have to understand the actual logic behind it. At its core, a trend line is just a simple technical tool. We use it to identify trend direction, pinpoint precise entry opportunities, spot potential reversals, and measure the overall momentum of the market. When you draw it correctly, a proper trend line is basically your anchor. It keeps you firmly aligned with what the market is actually doing instead of what you want it to do. It stops you from trading randomly and trying to catch falling knives, serving as a visual map of exactly where buyers or sellers have historically stepped in.
Moving right along to Section 2, mastering the uptrend line, writing the higher lows.
Taking this from theory into practical application, the absolutely crucial point here is that the structural foundation of any valid uptrend relies entirely on higher highs and higher lows. That's it. If the market isn't consistently breaking previous highs and respecting those previous lows, well, you aren't in an uptrend. You're probably just stuck in consolidation. You actually draw an uptrend line by connecting those higher lows. Think of it like creating a diagonal floor that visually represents all that aggressive buying pressure stepping into the market.
Now, to do this correctly and mechanically every single time, I want you to use this exact four-step checklist. Step 1, identify the first major swing low in the market. Step 2, pinpoint the second higher low. And listen, this has to be a clear, unquestionable pivot point. Step 3, connect those 2 points with a straight, clean line. And Step 4, simply extend that line forward into the future. Boom, that extended line just became your highly probable future area of interest. See, you're not guessing anymore. You're systematically tracking the market's footprint.
And the beauty of this is incredibly straightforward. As long as price keeps respecting that line and bouncing off of it, buyers are firmly in control, and the trend remains strictly bullish. Your bias is long, period. If price drops down to test that line again, you're immediately looking for confirmation to buy. It's a simple, rule-based system that completely removes all that emotional static that ruins so many trades.
Okay, let's flip the script. Section 3, mastering the downtrend line, tracking the lower highs.
So, looking at a bearish environment now, a downtrend is purely defined by the constant creation of lower highs and lower lows. In stark contrast to what we just looked at, the sellers are completely in the driver's seat here, aggressively pushing the market to new depths. And to visualize that heavy bearish pressure, you draw your trend line by connecting those lower highs. You're essentially capping the market with a descending ceiling of resistance.
Your execution guide here is just as strict, but super simple. Step 1, find that first major swing high. Step 2, connect it to the very next clearly defined lower high. Step 3, extend the line out into the future. By locking into this disciplined, 3-step routine, you're establishing a hard boundary on your chart. So, when price rallies back up to test this line, you aren't panicking or FOMO buying. Instead, you're patiently waiting to see if the sellers are going to defend their territory. And this brilliantly illustrates the whole point of a downtrend line. If price keeps rejecting off that line, sellers remain strong and the trend stays undeniably bearish. Every single touch and rejection is just further confirmation that the institutional order flow is still heavy to the downside.
You literally just ride that wave down until the market explicitly tells you otherwise by breaking its own structure.
Which brings us to the really fun stuff. Section 4, SMC and market structure, the secret sauce.
Pivoting from the basic mechanics into the more advanced confluences. You see, a trend line all by itself, it's kind of vulnerable. But when you start combining trend lines with market structure, liquidity pools, horizontal support and resistance, and smart money concepts, now you've engineered a seriously robust trading model. This is absolutely vital for highly volatile assets like gold, XAU-USD. Gold literally loves to sweep retail trend lines just to engineer liquidity before making its real move. If you only trade the line blindly, you become the liquidity. But if you pair that line with a solid understanding of where institutional money is resting, you completely avoid the trap.
Which brings us to a really profound truth. Trading is about discipline and structure, not just drawing random lines on a screen. It requires real patience. The market does not care about your hastily drawn diagonal line, I promise you. Long-term success comes from a strict adherence to rules, waiting for multiple confluences to line up perfectly, and keeping those destructive, emotional impulses completely out of your execution process.
All right, final stretch. Section 5, correct versus wrong trend lines. Stop forcing it.
Now, what's really interesting about this comparison is the stark contrast between how retail traders totally misuse these tools and how professional, institutional traders apply them. First, consider the classic retail habit. Force trend lines. This is the trader who so desperately wants to take a trade that they just start forcing lines everywhere, literally cutting right through candle bodies and ignoring real market structure just to validate their own bias. It's messy, and honestly, it's really dangerous. Now compare that to smart money trend lines. Notice how a proper line effortlessly touches the obvious swing points. It looks entirely natural. It respects the organic flow of price rather than trying to dictate it.
The core lesson I want you to take away here is that a clean trend line should practically draw itself. It should connect obvious, highly significant swing points. It should look natural to the eye, and above all, it must always respect the underlying structure of the market. If you catch yourself zooming way in, adjusting your line by a single millimeter, or cutting through solid candle bodies just to make your setup fit, stop. Seriously, just stop. You're forcing it, and you're walking right into a trap.
So, I want to leave you with this final, somewhat provocative thought today. The next time you open your trading platform and pull up a chart, before you even think about placing a single trade, ask yourself, are you truly reading the market structure, or are you just drawing what you desperately want to see? Mastering trend lines isn't about being an artist. It's about disciplined, objective observation. Apply these rules, wait patiently for your confluences, and let the market reveal its true intentions to you.